Hey everyone, here's your weekly market outlook for the week of 15th of July 2024, and let's just dive into last week's number. Very interesting to look at how the US data has been coming out a little bit more on the negative side. We have a softer inflation overall. Everything is pretty much below consensus. Headline inflation at 3%, that's a drop from 3.3%. That's lower than the consensus of 3.1%. Core inflation also dropped below consensus. We have seen a drop from 3.4% to 3.3%. And what's really damaging here, it's the monthly growth rate on the inflation here. We got 0% to negative 0.1%. Market is expecting a little bit more of a 0.1% growth. We didn't see that. We got negative 0.1%, and core inflation also dropped from 0.2% to 0.1%. And in addition to this set of numbers, if we take a look at the employment numbers, the labor data, unemployment pushes beyond 4%. It's at 4.1%. We have comments coming out from the FOMC being a little bit more on the dovish side. So market is currently pricing in for that rate cut to be a little bit more on the imminent side. Market is currently pricing in for a high probability that a September rate cut is going to be live, right? So that puts pressure on the US dollar. I think that's a relief in a sense to a lot of the global currencies out there. We saw the US dollar being pressured, and obviously the momentum is there. And we have been talking about the potential for Japanese intervention. Should it happen again to help out, to prop up the Japanese yen, that would happen with a softer data coming out from the US. And that's basically what the MOF and the Bank of Japan took advantage of last week. We saw that push immediately after the data got released. We saw the first intervention, and then we have another intervention on the next day, which is on Friday last week as well. So we had that Japanese intervention, and it changes up the dynamics a little bit. It does kind of put a lid on the gains on the Euro USD, the Aussie USD, and the Pound USD. We'll take a look at that more on the technical side of things. But for this week, we're focusing more on the UK inflation number. We've got the Canadian inflation number, which is going to be on Tuesday and then Wednesday, and we have the retail sales number in the US. We also have the interest rate decision coming out from the ECB. And in terms of the interest rate here, we're not expecting any rate cuts coming out from the ECB. I think the rate is going to be stable, pretty much at 4.25%. And then we have the Japanese inflation number on Friday, as well as the UK retail sales number. So yeah, it is another interesting week here, especially if we are focused on the Euro side and the sterling side. This is going to be the week where we are looking for more evidence whether or not the Euro and the sterling can actually gain against the US dollar here. Very interesting week to watch out for. All right, going on to the technicals, we'll take a look at the Aussie USD here. Remember, we talked about this being stable. It was in range between 66 cents and 67 cents. Once 67 cents was broken, it's pretty much going to the next key level, which is at 68 cents. Now, this is pretty normal for an Aussie USD movement. It does pretty much move within a 50 to 100 pip range, and it kind of stabilizes itself. We do find a resistance at 68 cents at this point in time. That's going to be the main resistance to be broken. But on the bright side, if we take a look at the movement here, we had a push higher. We had a little bit of a pause for 2 months, and then it breaks higher here. And the notion that we get here is that we're likely going to see a well-supported Aussie USD going forward here, especially with the RBA being a little bit more on the hawkish side, and especially with inflation in Australia picking up here, and then the RBA might need to hike rates instead of cutting interest rates for 2024. So that does give a fundamental support for the Aussie USD here going forward into the future, considering that the RBA potentially needs to hike interest rate one more time in 2024, with the FOMC currently being priced in for a September rate cut. we are looking at a potential Aussie strength going forward into the future, but it's still going to be contained within this range here. So we are likely going to see that resistance coming in at 68 cents. And then we are likely going to start building new support potentially around 67.50 or even towards 67 cents. But generally, even if it does pull back all the way down to 66 cents, it will still maintain that uptrend for the Aussie USD from a technical perspective. Now, next is the Euro USD, and for the Euro USD, the dynamics here is that we're still looking at that range here where 1.0850 and 1.09 could actually be a little bit more of an order block for the Euro USD. And the movement here for the Euro, it should have gained a lot more than 1.09. However, it's not progressing any higher at this point in time. And one of the main reasons is the intervention that was done by Ministry of Finance and Bank of Japan not only dragged down the US dollar, it does drag down the Euro, yen, as well as the sterling yen. Now, in particular, the Euro yen, it does come into the radar here by the Bank of Japan because part of the intervention that happened last week. So we had the first intervention on Thursday, and then on Friday morning, early morning in Asia, what we got was there was a little bit of a rate checking on the Euro yen. Now, rate checking for intervention is normally done on the dollar Japanese yen, but in last week in particular, I was focused more on the Euro yen, and I think one of the main reasons why this is the case is because Euro yen hits an all-time historical high. So I think there was also a lot of focus here for a potential intervention. If I can't get it done on the dollar side, we might actually get it on the Euro side as well. So we had a little bit of a rate checking, caused a little bit of a market scare. Market pushes up higher, and then post PPI numbers, we had another intervention by the Japanese government as well. And this is all leveraging on the softer data coming out from the US. So I think that's a very smart move, but it is a move that the market has already predicted, that we anticipate an intervention could be a reality if there was that softer data, because what the Ministry of Finance and Bank of Japan does was just leveraging on that momentum, because then in terms of the size of the intervention, it's not huge, right? If we compare it to May's number, it was 9 trillion April-May intervention, it was about 9.7 trillion Japanese yen. Last week's intervention, if we get a little bit of a rough estimate, it was totaling just about 3 trillion yen. Does it do a little bit of a damage into the dollar Japanese yen? Does it help prop the Japanese yen? Yes, but is it going to last long? Probably not. That's something that we're going to touch based on the dollar Japanese yen technicals. Now, next is the sterling. Now, with the sterling, we did point out here, a couple of outlooks previously. Every single week we put a note here that sterling, it's actually a pretty good currency. Now you can see this, the gain on the sterling here. And last week we talked about one particular level that was 1.2850. And once that level was taken out, it just opens up the potential for sterling to rally up even higher. Now, what we saw here is that we saw the sterling break 1.29, 1.2950, and it is now approaching 1.3. Now, 1.3 is a very important psychological price level, and this is kind of the potential limit in terms of how far the sterling could go before correcting itself. So we are very close to that level here. So we're definitely going to keep an eye out as price comes near 1.3. Whether or not there's going to be some profit taking. If there is, then we should anticipate a little bit more of a correction for the sterling here. And how far should the correction be? The correction could be in the range between 1.2850 1.29, but it shouldn't be lower than 1.2850. So that's something to watch out for here on the sterling. Now, this is the dollar Japanese yen, and for the dollar Japanese yen, before the intervention, what we were looking out for last week in particular was that we want a deeper correction. As I said, carry traders are not going to be willing to pick dollar yen, at a level of 161, 162. And last week's outlook, I said, what's the ideal level? The ideal level that I really want to see was 158. And what we can see here, post-intervention, the drop was towards 157 to 157.50, and then we saw a quick pickup on Thursday. We saw that another drop on Friday on the second intervention there. Price dips a little bit lower, but it was still above 157. In essence, we still see a little bit of a floor at 157.50. Now again, this is more or less the ideal level. Why was that the case? Because if you take a look at the number of correction here in terms of how far it corrected itself to 61.8%, which is kind of the normal correction range, and this is the ideal range if a trend is going to continue to pick up, and this is the ideal price if carry traders are looking at this and say, you know what, this is a good discount, because instead of buying it at 162, 161, I'm getting it at a cheaper price at 158. I mean, some of them got it in at 157.50 and 157. So overall, I think this is still considered to be more or less a buy on the dip scenario. Positioning wise, in terms on the underlying trend, is that this is still an uptrend. There could be a correction all the way down to 156. You know, a lot of traders are going to be looking at this and say, you know what, this is a good price. The lower it goes, the better it is for me to do my long-term carry trades, right? Because it's going to be at a cheaper price. You know, July, it's very interesting because we also have the tapering that's going to be announced in July by the Bank of Japan. You know, there are rumors swirling around that the Bank of Japan potentially needs to high interest rate as well to kind of support yen. But you know, on the overall grand picture, by hiking interest rates, and even with the FOMC cutting interest rates, you know, Bank of Japan hikes 25 basis points, FOMC cuts by 25 basis points, and it's shown us a gap by about half a percent, right? But if we take a look at the whole grand picture here, we're still talking about, you know, 4.5% of interest rate differential. That's not going to stop carry traders from, you know, shorting Japanese yen again. So I think this is very attractive for the dollar Japanese yen. You know, I think it will still play into the buy on the dip scenario. So just keep that in mind instead of blindly just continuing shorting the dollar Japanese yen here. There could be a potential that, on the flip side, carry traders are going to be eyeing and looking at the current situation as more of an opportunity to buy back into the dollar Japanese and to, you know, kind of lift it back up again. It doesn't have to go to 165, you know, just pushing it back up to 162. That's already a very good 4 to 5 yen profits for a lot of the carry traders. So, you know, that's the potential likely scenario here. The only exception here is if we actually saw that drop below 154.50. Any drop below 154.50 would actually reverse the long-term view of the dollar yen being in an uptrend. Any daily close below 154.50 would actually tell a lot of traders, you know what, the rally has ended. Be a little bit more on the cautious side, because we then would anticipate a little bit more of a range bound market condition. So yeah, a lot of focus on dollar Japanese yen. Make sure you are looking at this from the right lens. Do not make you know, the mistake that, you know, a lot of traders make by ignoring the underlying fundamentals in terms of the interest rate differentials between the Bank of Japan and the FOMC, and the potential next step that the Bank of Japan could potentially take. Okay, so with that, good luck with your trades, and I'll see you soon.